Hi, my name is Scott Dahl. I would like to welcome you to my sixth podcast in my series. As I've said previously, that what I would like to ask you to do is, if you haven't done so already, start with number one and work your way through, because what I'm doing is sort of building a knowledge base, giving you an idea of how I manage money, and then eventually we'll work around to what I believe is going to happen in the future, and you'll understand why I believe that. A little bit about myself. I'm a registered investment advisor. I've been registered Dahl Capital Advisors Incorporated since 1996. I have been in the securities industry for 40 years. I got Series 7 license in 1983. I'm a technical analyst. I am a chartered market technician. The acronym is CMT. I was the 291st person to earn this accreditation in 2001, and it's the highest accreditation you can earn in the field of technical analysis. I have been reading and drawing charts since 1976. I was 16. It started as a hobby, and it's thankfully has transcended into a 40-year career. Let's get started. I want to just give a brief review of what we've discussed in the past. We've talked about, which is a very important concept, secular markets versus cyclical markets. The market's a psychological mass, and so a mass has a tendency to stay in motion until it's disrupted. So you have these long-term trends that persist, and that's a secular trend. The analogy I used, if you look at a secular bear market, a long-term bear market, it would be a person on a escalator going down with a yo-yo. Long-term secular trend would be the escalator moving lower, but with the yo-yo would be going up and down during this escalator ride, and that would be a cyclical move. So you have a long-term secular market, either bull or bear, and you have these shorter term bull and bear cycles inside this longer term trend. That's secular versus cyclical. We'll also discuss trend lines, support and resistance. You have areas where as the market's dropping, you have areas where the demand for the stock and the supply, they become an equilibrium point, and it bounces and it turns back up. So these are areas of support that you can identify. You put a trend line down below them, and then you have areas of resistance. And it's a similar principle where it goes up and hits a certain level. The market hits a certain level and bounces off. And I've shown you examples of how you can see these very well defined. You put a line across the top, and the market breaks through this resistance area. It will either go higher, it'll come down and test that resistance area, then go higher, or it may come back down in the area and get caught in that congestion once again. So if it breaks through a resistance area, it's not always guaranteed it's going to go higher. To wait for and use technical principles to determine that, yes, we are in a new trend. So also we discussed interest rates. Interest rates move in 22 to 37 or 40-year secular trends, depending on how you measure it. Interest rates started down in 1982. They bottomed a few years ago, and now they're going higher. And you can see that the interest rates have broken out, and I demonstrated this, and they're going higher. How long are they going higher? Well, they broke this significant trend. So the mass is headed up now. We can assume, with no guarantees, that we're going to go higher somewhere between 22 to 40 years, because that's been our past experience. So interest rates are going to go higher for a long period of time. And how's that going to affect the bond market? Well, bonds are going to go down. If rates go up, bonds go down. It's a mathematical certainty. Are bonds going to go straight down for 40 years, or 22 or 40 years? No, because you're going to have cyclical ups and downs inside this longer term secular trend. But we're not going to be in a bull market like we were from 82 to roughly 2018, because rates are going higher. So it's going to put long-term pressure on bonds. How's it going to affect the stock market? Well, the stocks don't like high interest rates because it costs more to operate. It costs more to borrow, it costs more to produce your product or your service, and that puts pressure on the stock market. Inflation, it looks like it might be abating now to some degree, but once it gets started, it's very, very hard to stop it. And if rates are going to go higher for a long period of time, then it would justify the idea that inflation is going to go higher as well. So we'll have periods where inflation backs off, but more than likely, inflation is going to go higher for a long period of time as well. And part of the logic behind that is, as I explained in previous episodes, the Federal Reserve flooded the system with money, unprecedented. They gave people money directly. They've never done that before. And Michael Bryan, I quoted him previously that he is the chief economist for the Atlanta Fed, and so he's somewhat of a voice for the Fed. And through his research, what he said is he believes that the reason that we had this significantly high inflationary period from 1966 to 82, or the 70s and the 80s, early 80s, was because the country, the government, put way too much money in the system. If you have more money in the system and you've got the same amount of goods, the price is going to go higher. So you're not getting less pizza for your money. You're getting the same amount of pizza, but you're paying twice as much for it. That's inflation. Now what I'm going to do is I'm going to show you a long-term chart of secular bear markets. Before I do that, I want to discuss the theory of alternation. There's a theory in technical analysis which is called the theory of alternation. And what it basically says is your defined trend that you're in is probably not going to be like the one previous. It's going to be like the one before it. So that's the theory of alternation. So the secular bear market that I believe we're in is not going to be like the previous one. It's going to be like the one before it. And you can see that playing out. And I'll demonstrate that on the chart. Now, the theory of alternation is nature's law, and that's why we consider it valid. For example, the moon alternates in 4 phases. The days of the week alternate in 2 stages. Also, human activities alternate. And that's what gives us not only the bull and bear markets, but that's what gives us secular trends, structural trends with the market and the economy that are not similar to the previous experience, but the one before it. So with that said, let's take a look at this chart. So what I've got up is I've got a chart of the Dow Industrial Average. And if you can see the dates along the bottom here, it's from right around 1915 to pretty much close to current day. So you see those dates down here, the years. So it's a lot of data. And then you see the price running this direction right here. 1929 to 1942 period was a secular bear market that was punctuated by low inflation, low interest rates. So we know what this was. This was the roaring 20s, and we know that this culminated in a depression, which sent stock markets significantly lower. So this is again, a low inflation, low interest rate bear market. And low inflation, low interest rate bear markets, they drop hard, they bounce, then they just sort of bounce along with no real defined direction, and then something jars it out and gets a new bull market running. And so we know what happened here in the early 40s is it was the boys came home from the war and they started buying stuff, and they retooled the factories, and not to make ammunition, but to make refrigerators. And so we had this big boom of consumer activity, which started this new bull market. Then what happened is we got into this bear market from 1966 to 1982. This is a high inflation, high interest rate bear market. They're not the same. High inflation, high interest rate bear market, it doesn't have these big thuds. What it has is it has this long-term period of go nowhere where we have these really strong cyclical bull and bear moves inside this longer term go nowhere secular trend. So you can have bull bear markets that can last 2 or 3 years, but still the structural trend, the secular trend is sideways or perhaps even down. Here's a low inflation, low interest rate bear market. So it's not like this one. It's high inflation, high interest rates. It's like this one, the theory of alternation. So you can see here, 2000 to 2009, this was the dot-com bubble. We had a rally, looked like things were going to be pretty good. And then what happened is we had the real estate implosion that created the economy, and that sent the prices even lower. So this, they took out the lows here. So this was very brutal, but it was these big thuds, these big drops. And then we started in a new bull market. Where are we at now? Well, I've made my case that I believe we're in a high interest rate, high inflationary period. It stands to reason that would create what would be a secular bear market, high inflation, high interest rates with, sure, we're going to have cyclical ups and downs, cyclical bulls and cyclical bears inside this longer term trend. But I believe that we've got something similar to what we saw in the 1966 to 1982 period. Now, will it be the same? Of course, it won't be the same. It's similar because it's a similar economic structure, but it's not going to be perfect to what we saw in 66 to 82. But it's probably going to be painful over the long-term period of time. So this is 1966 to 1982. Market went virtually nowhere for this entire period of time. This is the Dow Industrials again. That's been my example pretty much throughout all of my presentations. And you can see that we had a peak here in 66. We had the significant sell-off. We went down 25%, up 33%, down 36%, up 66%. Looked like things were going to take off, a new long-term secular bull market. It didn't happen. We fell right back down into this sideways congestion. We had this tremendous 45% sell-off. You see the point here, up 76% off that bottom. It failed again, down 26%, up 36%. And it took a long time for this secular bear market to stop and for it to break out and head higher. Remember, it's a mass. So the mass broke out and the mass started in a new direction. So we waited a little bit, see if it was successful, and it was the start of a new bull market. So these are high inflation, high interest rate bear markets, and that's more than likely the environment we're in right now. So give me a call if you'd like to discuss these ideas further. My phone number is 949-497-6366. You can reach me at scott@dollcapitaladvisors.com. That's DOLLCAPITAL, advisors with an O. Or just go to dollcapitaladvisors.com and you can hit my website and you can reach me through there. And I'd be happy to talk to you about my services, and we could talk about the market further. So thank you again for your time. I really appreciate you folks watching these, and I look forward to presentations in the future. Thank you.